What are some of the one-off taxes that are specific to real estate that people might not know about?
Yep. So like you said, Australia is a very high tax country. They have taxes like from the ATO, and they also have a separate tax from the State Revenue Office, which is called the stamp duty. And that stamp duty applicable when you buy whether a brand new or second-hand property. And if you're buying as a first home buyer, you may get a little bit of concession from the government. But if you're buying it as an investment, the rule changed. Okay. So that is a once-off stamp duty, which could be in between 3 to 5% of your purchase price.
All right. So, you know, I did do a big session, I think, with Greg a few episodes ago. So we won't go into too much more detail on that. But stamp duty is like the door charge at the nightclub. You've got to pay it if you want to get inside. So you want to buy a property, you've got to pay it. So it's important that you understand that, you factor that into your calculations. There are ways to minimize it. We're not going to take up your time today. Do go back. I think it was about 3 or so episodes ago. We even had the whiteboard and ran through that. Have a look at that and that'll give you plenty of insight. Okay, so if we think about then ongoing taxes, what are some of the other taxes other than obviously income tax that are specific to being a property investor that you might not have thought about before?
Land tax.
Taxes. I thought he was going to say there are no other taxes.
No, land tax.
So in a simple view, what is land tax?
So land tax is applicable or is payable or based on the land value that attached with the property that you bought. So the concept behind it is like, say, if you're buying a house or you're buying a townhouses, the land portion of that property, the purchase price, let's say it's worth $1 million. The land.
Now, my friend, I've got a whiteboard. Come on, hop up. Let's have a look. While you're explaining it to people, I'm going to do some numbers here. So land tax, you're saying, all right, your property you've purchased for, say, $1 million.
Yep.
Do you pay the tax on that?
You pay the stamp duty on that's correct.
Okay. So you've got stamp duty on here.
Yep.
And then the second thing that you've got is land tax. And land tax we're paying on the purchase price?
No, land tax is based on the land value, a portion by the purchase price. So let's say if you're buying a townhouses, the construction cost for the townhouse, let's say it's $500,000, and the government thinks the land worth about $500,000, then your land tax is payable on that $500,000 of the land price that contained within the contract, the cost.
Okay. So without going into too much detail, you know, it could be, if you had a vacant block of land, it could be as much as $1 million.
Yes.
And really depending on the type of property you've got, it may change. So, you know, we often talk about one of the great things about apartments is that the land component, as far as the State Revenue Office is concerned, is a much smaller value amount. So, you know, on something like this, it could be as little as, you know, 100,000.
Yep.
And so this is a percentage-based tax?
Correct.
And what's the rate roughly?
I think from memory, there was about 2%.
Yeah. Okay. So, you know, it could be quite big. It could be a little amount depending on what you're doing.
Yep.
You want to?
Yeah, no. So we don't just, the benefit of buying an off the plan or an apartment is this land value, using that as an example, let's say the land value is only $100,000. Usually you're below the threshold that is applicable for land tax purposes. What it means is like there's a threshold. Until then, you don't pay any land tax until you went above the threshold. So
it's just like our pay, where we can earn the first
progressive tax,
$20,000 tax free.
Yeah,
you're saying there's a tax free threshold as well for land tax.
Correct.
So potentially,
yep.
Whilst this is a tax that investors should be thinking about, depending on the value of your underlying land, it potentially could be zero.
Yep.
Okay.
Exactly.
All right. Well, there you go. A tax that you potentially could avoid if you don't spend too much. Now, for those of you that have got 5, 6, 7, 8, 9, 10 investment properties, you probably know everything about land tax. Those of you that have maybe only got 1 or 2, quite possible that you don't even have to pay land tax.
That's right.
All right. Now, let's get to the big one, income tax.
Oh, I love income tax.
It's everyone's favorite.
Yeah.
Not. No one likes paying income tax. Now, can you sort of just explain to us, because I know I'm going to keep the iPad because I know there's going to be a lot of questions coming through, but we just think of tax, right,
Yep.
as an average person.
Correct.
But as us esteemed chartered accountants, there's a few different types of taxes. So can you perhaps sort of tell everyone the different types of taxes and maybe just high level explain the difference?
Sure. So we spoke about the stamp duty, we spoke about the land tax. Now we're talking about the big taxes. So generally, when you buy an investment property, you got to face two different types of tax. One is the income tax.
Yep. Okay. So one is income tax.
Yep. And the second type of tax called capital gain tax.
Okay, so two different types of taxes.
Correct. Yep.
What's the difference?
So the income tax, look at it in a way that when you have a rental apartment, you're running like a business. All your rental income will be considered accessible for tax purposes. But however, while you're renting your property out to a tenant, you will incur other expenses such as owner cost fees, interest on your mortgage, land tax. Those are the expenses that you can go against the income that you earn from your rent. So this is—
So income tax is really for your rent.
Correct.
Okay. And capital gains tax, what's that?
The capital gain tax only applicable when you're selling your property at the end.
So that's on the growth.
So, correct.
If there is any.
Yeah.
Now, tell me, who cares? All right. My spelling is atrocious.
I didn't want to point that out, but that's okay.
Why is this important to understand the difference between the two?
So you pay a percentage of income tax. Like, let's say your taxable bracket is about 30%. And if your total rental income less rental deduction for the year is, say, $10,000.
Well, just tell us, so if it's 30% here, what's the tax rate?
Half of that, call it 15%.
So you're only paying 50%
of the 30%,
which is 15%.
Correct.
Okay. So simple thing for those non-accountants on the line, I want to pay half the tax.
Easy.
Okay. Let's just pay it 15%. So do I just write and say, dear Mr. ATO, I will pay capital gains tax and not income tax?
No, you can't do that.
Okay.
I wish we could, but you can't.
All right. So, if we want to move towards paying capital gains tax, or there's got to be ways that we can, minimize the amount of tax that we pay, even at least defer the tax that we pay.
Correct.
So what are some of the ways that we can access more of this lower rate versus a higher rate, or just anything that we can do to help minimize the amount of tax we pay? Because I don't think any of you want to pay more tax. We all know the famous line from Kerry Packer about why would I want to pay more tax? Because you're not doing a bloody good job with it to start with. And I think that's still relevant today. No one wants to pay more tax, right?
Correct.
I hate you because you're constantly taking tax. The amount of tax we pay, not only on our personal incomes, company tax, land taxes, payroll taxes, there's more taxes coming at our ears than we know. How do we minimize tax? What are some of the ways that people can do it?
Just remember one thing, depreciations.
Depreciation. Okay. So depreciation, what is it?
So basically it is when you buy an apartment, there's two components within your apartment. One is the construction cost, and there's also plant and equipment. The ATO basically allowed a taxpayer to slowly deduct those amounts on a yearly basis. So let's say if you buy an apartment for $500,000, and once you get a qualified quantity surveyor to give you the depreciation schedules, the annual deductions might be around $10,000 to $15,000 each year that goes against your income. So,
okay, 10 to 15,000 per annum.
Yep.
Now, I understood everything you said, but you know what? For most of my listeners, they didn't understand a word you were saying. It was technical, it was here. I'll put it simply to you. Think about it. You buy a fridge every year, it gets older and older and older, and after about 5 to 10 years, you throw it in the bin. Now, the fridge in your home, you throw it in the bin and that's it and it's done. What Derek was talking about is that if you're an investor, you pay for that fridge on day one. okay? Then every year, as it gets older, you can deduct a percentage of that fridge. So let's say in simple terms, it was a $10,000 fridge, bloody expensive fridge, but I'm doing this for the simple maths. And on a very simple basis, we said it would last for 10 years. Every single year, you can deduct $1,000. So you add up all those expenses, and that's how you get to this figure here.
Done by the, yes, correct.
Yeah. Now, obviously, you need a professional, a quantity surveyor. There's a lot of paperwork that needs to be done around it, but that is a big, big saving. So, you know, can we perhaps do a worked example? You know, let's say that we have, you know, let's say in scenario 1,
Yep.
you know, we don't have any depreciation. Scenario 2, we do.
Yep.
So let's say the rental income is $30,000. Okay. We have expenses, you know, council rates, taxes,
All add up.
water rates, whatever it is, of say $10,000. Okay. So we're left with $20,000 in our pocket at the end of the year.
Yep, before depreciation, correct. Yep.
So in our scenario 1, where we don't have depreciation, we're going to pay tax. Now, I don't have a calculator. I'm going to assume for the time being that you're paying 50% tax. Now, those of you smart people out there will know it's actually 47.5 or whatever, but we're not going to get that technical hit.
Yep.
Simply half the tax. So you are going to pay to the tax man $10,000, and you're going to be left in your pocket with $10,000. Okay.
Correct.
Great.
Yep.
I got 10 grand. Go spend it on a new car, holiday, whatever it is. Fantastic. Now, depreciation comes in before the income tax.
Yep.
So what do we say? Let's say we have $10,000 worth of depreciation.
Yeah, conservative.
So you're saying we take off $10,000 of depreciation.
Yep.
So now we end up with $10,000. Now, before we go forward, it's really, really important distinguishment to make here. That $10,000 of depreciation is what we call a non-cash expense. Now, the reason why that's important is you don't have to pay for it. You already paid for it when you brought the fridge, when you brought the building, when you brought the property. You know, whatever it is that you brought, you've already paid for it. So you're getting a deduction of $10,000, but you don't have just $10,000 in your pocket. You've still got $20,000 in your pocket. Now we go to pay the tax, and we're going to pay half. So we pay $5,000. We end up with $5,000 in our pocket, plus we've still got this $10,000, which means all up we have $15,000. Okay? That is the power of depreciation, because I tell you what, whatever car you're buying for 10 grand, you can buy a hell of a better car for 15 grand. You can go on 2 holidays, perhaps even. And it hasn't cost you anything. Okay? Simply a bit of time to get this all set up, do the paperwork, get it right. And it's a really, really great strategy there. Not only are you paying half the amount of tax, who's not happy with that? You're ending up with 5 grand better off in your pocket. So really, really important distinguishment there. And I think hopefully the numbers help provide you a bit of a better understanding as to why that's so important. Now, it's not all roses when it comes to this.
Correct.
Because it does come back eventually. So upset everyone. What happens to the 10 grand? Because they haven't paid for it.
Yep. Or you going back to the $500,000 apartment example, what happened is you claim a $10,000 deduction as a depreciation in your tax return. So let's say you bought the apartment for $500,000. So your cost base now is going to be reduced from $500,000 to $490,000. So let's say if you're selling the property right away at the market value, which is also $500,000, you would crystallize a 10 grand of capital gain immediately. However, the good news is capital gain is only taxed at 50%. So what it is you're basically just paying 15% of the 10 grand profit, which is about $15,000. Comparing of paying additional $5,000 tax year, you save $3,500 immediately just by deferring and using depreciation as a weapon.
Okay. Now, again, you might be lost with that. I'll make it really, really simple. Get a good accountant. Lucas said before, get professional advice. Unfortunately, he's too expensive. We pay him far too much. But remember what Lucas said to you in the session before? He said, you've got to focus on the right mix of cash flow versus growth. Now, if you take the strategy of buying a property for the long term, potentially you might even say, I'm going to buy and hold forever. Don't worry about capital gain because it only crystallizes, as Derek said, when you sell the property. Well, I also explained to you how important it was to have enough cash flow to be able to continue to hold that property when things change in life. You know, who would have predicted 2 years ago we would have had a pandemic that's still going on 2 years later? So that extra $5,000 in your pocket, you know, over say 5 years, that's an additional $25,000. You can do a lot with that, okay? Obviously, we're using small numbers here. Multiply that out and it's going to make a big difference. All you have to remember is that that will eventually come back when you do sell the property, but at half. So you've saved $5,000. You've got that in your pocket today. And say you sell the property in 10 years' time, instead of paying that $5,000 that you saved today, you'll only be paying $2,500 more than you paid before. Okay, very simple. All right. Anything else you want to share with our listeners, or do you think we've covered enough on taxes?
I think that's too much already.
Too much already?
Yeah, I think that's too much already.
All right. Now we might do this again because I know we've gone through a lot. Hopefully the whiteboard did help you get some numbers. My writing was particularly messy today. I will try and be a little bit better in future. If you've got any more questions, drop them in the Q&A, the chat, the comments if you're on Facebook, and we will go through those and come back to you as soon as we can. But I think that's it.